In today's video, we're going to be having a deep dive into non-farm payrolls. We're going to look at what it is, why it's important, where we find the information, and how we might think about trading it. So to get things started off, what actually is non-farm payroll? In reality, it's an economic indicator and it measures the number of jobs that are either created or lost during a monthly period. Of course, it has a level of a smoothing effect that goes in because not every single job is actually counted into the non-farm payrolls events or data. They take out farming related, government jobs, private household jobs, and of course not-for-profit organizations. The whole reason of that is so that we get a smoother image of data as opposed to jagged edges. The same thing is incorporated into our CPIs. When we get core CPI, it's everything. When it's normal CPI, we get a removal of a couple of different metrics just so that we don't have things with spikes going on because they might be considered to be seasonal or cyclical styled pieces of data. So in this instance, farming jobs obviously get a bit of a spike when it is times for crops to be harvested. So therefore you get an influx on job numbers that may not actually reflect the overall economy. The other part that comes into it is that it's often combined with an unemployment rate. And both of those are obviously very important figures because it's about evaluating and measuring how the economy is actually traveling. But the other important part about non-farm payroll is when it is. It's always the first Friday of every month but at 8:30 a.m. Eastern Time. So it makes it really easy to have a look at, and because of the influence on the economy that has, especially when you think about jobs and how it all works across the board, it is a very important figure to be tracking. And there's a reason for it being important in that front. The Federal Reserve watches two things. The first one is inflation and the second one is jobs. Generally speaking, what you can look at from history and eons gone past, a lower unemployment rate means that we have higher interest rates. When we have a higher unemployment rate, we have lower interest rates. And if you look at the situation that we're in today's method, then you will notice that similarity is still there. Now, really, what is it at the end of the day and why is that important still there? It's a gauge of economic health in a more generalized approach. It gives us an idea because it does get tracked on a monthly basis. It's very easy to see where things are going. And if we go a little bit deeper into some of the other supporting indicators that come forward, then we can actually see it almost on a weekly basis, particularly with unemployment job claims and the similar. Now, where might we actually find some of the data? Well, the first thing you need to know is it comes from the Bureau of Labor Statistics. Of course, almost every economic calendar on the planet will go and have it there available for you, so you can quite often see the time that it's coming out, see the forecast for the job numbers, see what it was previously, and then, of course, when the actual result comes out, usually see it there as well. But if you want to get a little bit deeper into it, it will usually link you straight to the BLS website, where you'll be able to look at the report in depth. Now, generally speaking, we look for a couple of little things, and those little things are going to be revolving around how many new jobs we have, how many were full-time, how many were part-time, how many were casual, and of course, what the percentages of change are going to be around that. Is it better than what we forecast? Is it worse than what we forecast? Is it right on the actual announcement? All of those are kind of important figures to really be looking at. Now, how might we think about it when we're actually trading around non-farm payroll, or NFP for short? The first thing is that the forecasts are generally priced in, and we see an early warning figure from the ADP, usually on about the Wednesday or the Thursday night before. When it comes out on the Friday, we generally have an idea of where it might be going because we've seen an estimate at that stage, and generally that estimate will migrate into the forecast. But it's not always the case because they do work independently occasionally. Now, what we should really be looking at is how it is going to affect different markets, because it will affect a number of markets. If we think about the shift that we see in employment figures for the US just in 2020, you'll notice that as we've seen massive rises in unemployment, we've seen global economy start to track with it. The reason for this is that the US is one of the larger economies on the planet. We have a lot of investment that goes through their country, mainland, their currencies, their equity markets, you name it, they have some level of fingers in the pie somewhere. So when it comes to tracking how their employment situation goes, it reflects on how their general GDP is going to run, how the Fed is going to respond, and more importantly, what stimulus the Fed might decide to do. So all of those become important figures from a fundamental scale. Of course, you can look at it from a sentiment perspective. If we assume that in most instances the estimate data will be priced into the market, then it's really only if we get a shock factor that says massive swing down or massive swing up that we are going to actually see a bit of a shift in that market in the immediate spot. But it's not uncommon. It's not uncommon for it to actually see a spike in data. Sometimes the spike goes up and down. So it's always generally by a rule of thumb that technical traders apply is to either try and trade that spike, usually by offsetting with a position on the top and bottom. Not something I recommend because it can mean you end up in an accidental hedge, but certainly looking at it from a little while after. So if you give it 15 minutes past a release, you let everyone get a little bit of the jitters out of their system, then you start looking for your position. Now, if you think it has gone incredibly up or incredibly lower, then make the move surrounding it at that point in time. But there are a number of other factors that you can look at when you consider this. You can then look at a unemployment data or the NFP tracking and then get a bit of a gauge on where you might think over a longer term where the Fed might go next, particularly with stimulus, which is probably arguably a little bit more important for us because it will affect the US dollar directly by printing money, as opposed to indirectly in this case. Now, of course, that's really all I've got for you today, but I am happy for you to send me questions. If you feel I haven't explained something clearly or you're just not quite understanding, don't hesitate. Send me a message and I'll do my best to try and give you a bit of a hand. Now, the contact details are on the screen behind me. The easiest is probably my email at talktoal@acy.com, but the other socials are also available. Now, don't forget to like and subscribe to this video so you can get more great content from me and ACY Securities in the future. Have a great trading day ahead.